This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stock futures are flagging a weaker open despite a US rebound as buyers scooped up bargains following Monday's sell-off. Wall Street's fear gauge seeing its biggest plunge in 14 years. Also ahead, the Democratic nominee Kamala Harris picks Minnesota Governor Tim Walz as her White House running mate in a pitch to reunify the party's base. Plus, we meet the man running the Adani Group's energy business for exclusive insight on their green pivot and the impact of the Hindenburg research allegations.
From our viewpoint, purely this report was nothing but accumulation of everything that was written and alleged over the last 10 years before that, but also very beautifully gift-wrapped and presented in a way that was, explosive and shocking.
Some data crossing the Bloomberg at the top of this hour. South Korea's current account balance coming through with that goods trade surplus widening to just about $11.5 billion. The broader current account surplus widening to $12.25 billion there as well. So, of course, we continue to scrutinize each and every piece of data, really, when it comes to what the potential implications are for global central banks. We've seen really some of the details when it comes to the current account surplus. They're coming through with that big move when it comes to goods. Obviously, exports for South Korea, one of the most keenly watched broader indicators in terms of the strength of regional and broader global trade, particularly when it comes to tech, Shery.
Yeah, and those tech exports really closely watched to sort of gauge the demand from global economies, right? The U.S. election cycle really key in terms of what markets are watching when it comes to this year's really trajectory for global economic policy as well. And we just heard from the running mate of Vice President Kamala Harris, the governor of Minnesota, Tim Walz. And it really was interesting how he started his speech talking about the joy that Kamala Harris was bringing to the U.S., contrasting her track record against that of Donald Trump, and also really talking about himself as well, right? I mean, he's a native of rural Nebraska, sort of balancing out the ticket for the Democrats against Kamala Harris as well.
Yeah, and of course what we're also watching is where we go next with the market turmoil that then turned into obviously that market rebound, and lots of questions as to whether we're at the bottom of this, right? And one of the ways we're looking at this is really kind of, we can call it the smart money buying, if you will, offering that glimmer of hope that perhaps we have really bottomed out with that $1 trillion sell-off on Monday. Big money investors doing something that are usually reserved for kind of the braver retail crowd, which was actually buying the dip. So we saw single stocks in the US seeing the most net buying since March, according to data from Goldman. Still looking costly, but, quote, you can tell yourself that it's a deal. Hedge funds making both bullish and bearish wagers on equities, snapping up those individual US stocks at the fastest pace since March. And we're seeing also data from JP Morgan Chase showing that institutional investors picking up about $14 billion of shares on net during the downdraft as well. So lots of indicators perhaps that, this has bottomed, even if perhaps we're also setting up for more bouts of volatility in the coming months, Shery.
Yeah, so we saw, at least for now, that calm returning to the markets, right? That rebound that we saw in Japanese stocks in the previous session was really surprising. Right now, futures pointing to the downside after the best day for Japanese stocks since October. Of course, a lot to do with where the Japanese yen is headed. We continue to see the weakening trend around that 145 level against the U.S. dollar. We're seeing ASX 200 futures as well under a little bit of pressure. We did get the RBA holding rate steady, but at the same time, upgrading core inflation forecast and GDP forecasts as well. We also got New Zealand unemployment numbers just a few minutes ago showing that they rose less than expected towards that 4.5%. We're watching the offshore yuan as well, holding at that 715 level. Of course, Chinese stocks, a little bit of confidence still lacking when it comes to the Chinese market still, right? But take a look at how U.S. futures are coming online in the Asian session, given that, of course, we saw that optimism that you mentioned. Of course, the Magnificent Seven gained ground, not to mention cyclical stocks in the Russell 2000 as well. We're seeing a little bit of pressure in the open at the Asian session, with Nasdaq 100 futures down about 0.5%. But suffice it to say that really that calm returning to the markets, with the VIX indicator also falling by the most since 2010. We continue to watch the Treasury space, a little bit of downside for oil prices after it rebounded from that 7-month low with that broader equity rally as well, Haidi.
And let's get the latest in politics. And of course, we'll be watching the Democratic presidential nominee Kamala Harris picking Minnesota Governor Tim Walz as her White House running mate, and a pitch to unify or reunify the party's base. Let's get more on these US elections and what we're watching. Bring Bloomberg Balance of Power co-anchor Kaylee Lyons. So, Kaylee, at the end of the day, it essentially came down to two governors. It was really interesting that Kamala Harris chose to sort of sacrifice Pennsylvania, right, in favor of Tim Walz. What does he bring to the table?
Well, the Harris campaign would probably tell you, Haidi, that she doesn't think she's sacrificing Pennsylvania at all, that she thinks Governor Walz, as a Midwesterner, can still appeal to Pennsylvania and the other states that make up the blue wall, Wisconsin and Michigan, given that he does have that Midwestern attitude, can maybe appeal to especially the working class voters in those states, as he is a very pro-labor candidate, has had the backings of a number of labor unions who have come out to endorse him today. And it is worth considering, as we heard the vice president outlining at these remarks in Philadelphia that she gave on Tuesday evening here in the States, this notion that he does have a resume of executive experience. He is in his second term as a governor of Minnesota, in which he has benefited in this second term specifically from having a democratically controlled state legislature, getting through a number of progressive economic legislative priorities through. But he also was a legislator in the House of Representatives for 6 terms, 12 years before that. Before that, he was a teacher and a coach and served in the U.S. military. So the idea is that he has this resume that can appeal to many different groups of voters within the American electorate, and also kind of has this happy-go-lucky demeanor that is bringing more of that kind of energy to the Democratic ticket overall. We heard him when he was on stage in Philadelphia using what is now being a phrase that he is credited with coining, this notion that J.D. Vance and Donald Trump, the Republican ticket, are weird. He actually called them weird as hell in his remarks.
Will all of this be enough, though, to beat Donald Trump in November? What are the polls telling us?
Well, polls, at least for now, are not going to be able to really measure the Walz effect because he was only named this morning. But polling has been trending more positively in the direction of Kamala Harris. If she isn't outright beating Donald Trump by outside the margin of error, which we aren't seeing in nationally or in the critical swing state polls, she is at the very least polling better than Joe Biden was before he left the race. So that is really going to be the key test moving forward. To what extent do we see any at all, or if any at all, a boom coming from the Walz selection as vice president? It is worth keeping in mind here that the Democratic convention in Chicago is less than 2 weeks away. We could potentially see a boom coming from that as well. But we already are seeing, too, the reaction from the Republican side, heavy criticism of Governor Walz as being dangerously liberal or a radical leftist. That's the kind of thing we're seeing messaging coming out of the Trump and Vance campaign specifically. So it could be a lot of back and forth here that is going to move polls in whatever direction. But as they pointed out on the stage this evening, we're just over 90 days to go until the election. So all of this is happening at kind of a rapid speed, truncated timeline. And it is going to be a full tilt sprint between now and November.
Yeah, the progressiveness is really going to be interesting for that Rust Belt blue collar play too, right? But when do we hear from the candidates? What's the latest when it comes to these debates and the to and fro there?
Oh, the debates is an excellent question, Haidi. We know at the presidential level, Donald Trump has agreed to one debate on Fox on September 4th that Vice President Harris has not agreed to. She has agreed to be on a debate at ABC on September 10th, which Trump had previously agreed to when the Democratic ticket was actually being led by Joe Biden, not Harris. So there's still a debate going on about the debates. At the vice presidential level, it is just as much of a question. We did hear Governor Walz today saying that he cannot wait to debate Senator J.D. Vance of Ohio, of course, the Republican vice presidential nominee. So it's kind of a wait and see as to whether or not ultimately that is going to be happening. I would love an answer to that question from either campaign, but I'm not sure we're going to get a confirmation on that just yet.
Well, Kaylee Lyons, Bloomberg Balance of Power co-anchor, keeping us up to date with all of the political news out of Washington. And other stories that we're following right now, Bloomberg has learned that U.S. officials plan to propose limits on sales of Chinese vehicle software as soon as this month. Sources say the move will include curbs on the use and testing of Chinese technology for autonomous vehicles. The restrictions are meant to keep Chinese companies from collecting data on U.S. drivers, as well as building a bigger foothold in the American market. Hamas has named Yahya Sinwar as its new political leader, the alleged mastermind of the Gaza militant group's October 7th assault on Israel. The choice sends a message of defiance to Israel and the U.S. and is seen as a blow to efforts to broker a ceasefire. Meanwhile, Israeli forces have again exchanged fire with Lebanon-based Hezbollah. Israel's military says drones were launched into its northwestern Galilee region and several civilians were reported injured by an Israeli intercepted missile. Nobel Prize-winning economist Mohammed Yunus has been appointed head of Bangladesh's interim government. President Mohammed Shahabuddin announced the decision after consulting the armed forces and protest leaders who called for Yunus to be given the role. Former Prime Minister Sheikh Hasina fled the country after weeks of protests. Coming up on the Asia Trade, we'll talk market strategy with Nomura's Chris Willcox, and as well as HSBC's fan Cheuk as stocks rebound after wild rout. India's net zero ambitions also in focus with climate energy finance, as we hear from the executive director of the Adani conglomerate's energy business, Sagar Adani. This is Bloomberg. Take a look at how we're trading at the moment right now, because we are seeing a little bit of a mixed picture across markets setting up for the open in Asia. We are seeing some downside pressure for ASX 200 futures. Nikkei futures also down after the best day since October. Our next guest heads trading and investment banking at Japan's biggest brokerage. Joining us now is Christopher Willcox, executive officer and head of wholesale at Nomura. Chris, great to have you with us finally in person in the Tokyo studio.
Thank you for having me back, and welcome.
And what a week, right? Thank you so much for welcoming me to Tokyo, right? But I mean, what a week to have you on, because it's been such a volatile week. What do you make of it? Will the turmoil continue? Are we seeing an end to this?
So look, I think things are obviously a lot calmer than they were a couple of days ago. So things have stabilized. I think the fundamentals in the Japan economy and in the global economy haven't moved as much as these markets have moved. So I still feel pretty confident about the Japan economy. I still believe that the US will probably avoid a recession. So I think the real surprise has been the speed with which markets have reacted to new information. The real question for the sort of big moves that we've seen, like dollar yen, just the carry trade, for example, is the carry trade now priced out? I think not. I think if we look at the data that people often use as a proxy for the carry trade, which is the CFTC non-commercial shorts, that was at its highest level, a few weeks ago since the financial crisis. That is more than halved now, but it's still well above where it's been in the long run. So
does that mean that we have half a way to go still for that unwind?
I don't think it means that we have half the way to go, because I think that the first sort of 50-60% of the unwind is going to move the markets the most.
Okay.
But I do think we still have some of the carry trade on. I think JP Morgan recently said they thought it was about half done. I think it might be a little bit more than that.
Right?
Yeah, I think it's a bit more than that. But
okay.
As you know, we forecast dollar yen to go to 145 and 140 in the medium term.
I didn't trust your 140 when you told me that earlier this year. Are we still going to head towards 140 this year?
Well, look, as last time I was on here, I had made that prediction the time before, and we were at a 161, so people were definitely questioning that forecast. I think you need to be just as cautious about forecasting when it's gone rapidly your way. My suspicion, our long-term view was that the yen was undervalued at 160. We believed it would get to 145, possibly lower over the next year or so. We still believe that. Obviously, it's gone all that way in a very short period of time. So in the very short term, I think we could see it come back. But we still have a year-end forecast of around 148, and we still think it can go to 140 next year.
Does that mean that the BOJ doesn't do anything anymore? Because we were thinking, okay, they don't have a mandate on the exchange rate, but perhaps this was giving them some pressure to actually hike rates. When are they going to move then?
So look, there is an impact on central banks from currency moves, and so they can't ignore it completely because it has an impact into the real economy and into inflation. So I think there was pressure on the BOJ caused by dollar yen. However, many people have questioned whether the rate rise from the BOJ was a mistake and whether that's led to some of this turmoil. I would say that the BOJ has been completely vindicated because, firstly, it's proven to us that unwinding a very easy policy over a long period of time is likely to be a bit bumpy. So we've had this extraordinarily easy policy to deal with the deflationary environment. It seems like the deflationary environment in Japan is being dealt with. But they always knew that this unwind was going to be very difficult. That's why they've been so slow and so cautious. And yes, that puts some pressure on the yen for a little while. But I think it's right. And think about the carry trade. The point of the carry trade is that if they didn't start to move, the carry trade would only have got bigger. And so the end disruption of the unwinding of the carry trade would have been even bigger. So I think the BOJ is playing it extremely smartly.
Especially when we got real wage growth turning positive for the first time in more than 2 years, right? But if we get to your prediction of about 140 yen per dollar, where does that leave the stock markets? Because, I mean, the moves were really, really strong. 12 down, 9% up yesterday. We're still kind of, Monday seemed a blip in the overall level of the market. Then what does that mean if you continue to see strength in the Japanese yen?
Well, so clearly, these were very big moves, but I don't think that the moves in the markets were primarily driven either by what the BOJ did or by dollar yen moving. I mean, they were primarily caused by a reassessment of growth prospects in the US and a higher perceived risk of recession in the US and a correspondingly expectation of a more aggressive response from the Fed, right? So I think those are the things that are the real drivers. I think dollar yen, it's not very long ago it was at 145. A lot of people's budgeting is around 145. So I don't think dollar yen in its own right is going to cause a problem. I think at 145, dollar yen looks to me like it's relatively fairly priced. To make a forecast of where it goes in 2025, you'd have to have a whole series of inside knowledge about what's going to happen in the US election, what's going to happen in the global economy. But for now, I think that's a very reasonable level for us to be at. And
for now, at least with the robust stock market trading environment, Nomura has done pretty well, right? Triple your profit, given, of course, the wealth management boost. What are your expectations going forward, and where are some of those sectors that you still want to improve on?
Well, yeah, we're not by no means satisfied. We've had some good results over the past couple of quarters, but the plan that we have for the business is all the way out to 2030, and it's a very major plan around revamping Nomura from end to end. And the wealth management business has obviously been a very successful story over the last year, and we continue to invest in that. We also, in my area of the business, in wholesale, have had a big medium-term plan to turn the business around. We have a sort of tagline, which is stability, growth, and diversification. And although on the stability side, we're keeping our costs under control and investing in our risk management, but we're also investing in the business in an aggressive way. We hired over 500 people last year, and this year is all about monetizing the investments that we've made in those businesses. And it seems to be working extremely well. And at the core of it is the fact that we focus 100% on clients. And that client revenue is growing, and as a result, all of our metrics are improving.
Chris, I'm wondering if there's sort of more of a focus on costs at the moment. Are you doing anything, putting in place any sort of policy efforts to try and tighten the belt a little bit? We're seeing that from competitors and peers, certainly.
Hi, Haidi. So, yes, obviously we're focused on costs, but I would say that we came to that probably earlier than some of our competitors. So we've been doing it for a while. We've taken something like $250 million of costs out of my business directly But we're also thinking more structurally about the business as a whole and structural reform across our whole suite of businesses. And the reality of that is that often what you're doing is reducing costs in order to fund other investments that you want to make and other productivity and technology investments, etc. So net, we're not in sort of cost-cutting mode. We are actually in investment mode. It's just that a decent portion of that investment will be funded by cutting costs out of existing processes and defunct technologies that need to be replaced.
There seems to be, even with the recent rebound, and particularly with the focus on how much further there is to play for Japan risk assets, that maybe more volatility more frequently will kind of become the new norm. Does that mean that, obviously more opportunities, but do you trust that Nomura has the right people in place to be able to handle more volatility?
Well, look, I think we've shown that when the markets provide opportunities in the way that they have in Japan in the last year, that we're capable of monetizing those. And so I think that's a testament to the quality of the staff that we have at Nomura, but it's also a testament to the fact that our clients trust us and see value in the services that we bring to them. As you know, we announced a new group purpose earlier this year, where we say we aspire to create a better world by harnessing the power of financial markets. I believe in that very strongly. I think it's something that every day when we look at these volatile markets, we can spend time thinking about how we can add value to our clients, how we can advise them, how we can execute for them, how we can give them liquidity. So I think, volatile markets are things where clients need us to help them, and when our clients need our help is very good for our business.
When it comes to the self-funding principle that you guys have been talking about, you have that goal for the wholesale operation, but are there also other areas that you want to strengthen?
We're making significant investments in the wholesale business, but also in the wealth management business here in Japan. And obviously one of the areas that's been a big focus for us is wealth management in Asia, based out of Singapore, Hong Kong, Dubai. We have a wealth management business there that has now reached about $23-24 billion of AUM. We have an ambition to take that into being a top 15 wealth manager in Asia. So that's a big area of investment for us. And of course, as you have heard from our CEO, we're very focused on expanding our asset management business, and we'll be looking at both organic and inorganic opportunities to do that.
Chris Willcox, really great to have you with us in the Tokyo studio, Executive Officer and Head of Wholesale at Nomura, joining us here in Japan. More ahead on the Asia trade. This is Bloomberg.
All right, take a look at what we're watching when it comes to energy markets at the moment. Of course, Middle East tensions continue to weigh. We're seeing that rebound from the rout, that risk-on sentiment that we're seeing across broader markets is also applicable when it comes to trading in oil, but at the moment looking pretty flat, despite that coming back from a 7-month low with the sort of rebound rally in risk assets there. We're still sort of concerned when it comes to potentially futures being oversold, as well as we've seen prices for WTI close to the lowest levels this year. This is Bloomberg.
I think we're going to see more volatility in the short term here. This was a pretty big, pretty meaningful correction and a big unwind of leverage, as we had discussed. In certain parts of the system. My guess is we'll see a little bit more rebalancing. But my base case is still that there's a good chance the economy is still in reasonable shape. As we said a few moments ago, the jobs report, while it was disappointing, wasn't a bad jobs report. The unemployment levels are not bad unemployment levels. And so my base case is we're still set up, to kind of muddle through. But I do think in the short term here, the next couple of weeks, we might see a little bit more market volatility as this all rebalances.
Goldman Sachs CEO David Solomon there speaking to Bloomberg about his outlook for the markets. That has certainly been a few days for the books. But take a look at how we're setting up when it comes to this session that we're seeing here midweek as we get set to open in just about half an hour's time across major markets in Asia. Not quite sort of following the rebound rally that we had necessarily in some other global markets, where we're seeing quite a bit of downside here, particularly when it comes to the continuation of a fall expected in Japan. Nikkei futures flagged about 2.2% lower. A resumption of declines when it comes to Sydney as well, despite, of course, the RBA not coming out with many surprises in that meeting where they stayed on hold, but also continued to sound quite hawkish as well. That rebound, though, across most markets on Tuesday. US futures also falling in early part of the trade. Let's bring Gufford Reynolds, who leads our Markets Live Asia coverage. So clearly sentiment is still quite fragile.
Well, yes, as it should be. I'd be more concerned, in fact, if Japanese stocks just kept on going back up and refilled the gap from that 3-day drop was the biggest ever for the topics, for example. So that's worse than in the 2008 meltdown, worse than pandemic, worse even than the Black Friday event, its impact. So to have, if that was to get refilled so rapidly, then you would be sort of more worried. For the next few days, maybe even the next few weeks, I would be surprised if Japanese stocks can do the best they can hope for is to sort of meander along about where they are, perhaps grind a bit lower until we start to see more clarity on, has the yen carry trade been flushed out? Can the Japanese bond market settle down? What is the Bank of Japan going to do? You had some people running around saying, okay, that's it. The Bank of Japan shouldn't hike rates kind of ever again. They did it once and look what happened. But it wasn't just the Bank of Japan that was behind what went on. In a lot of ways, it was, to some extent, what equity investors had done in the run-up in just continuing to ignore these risks that were coming along. So I think it's going to be hard for a sustained rally to come from here, and probably the stronger the bounces we get, the more danger is that they reverse and reverse nastily.
And by the sounds of it, perhaps more pain to come, yet quite a bit of more pain to come when it comes to the unwinding of the carry trade.
Yes, yeah. Well, I mean, possibly. The pain, the pain is definitely there. The question is, how deeply will it be felt? We had a lot of positions obviously flushed out, a lot of leverage taken off. It might not be that too much more leverage gets taken off, or if it does get taken off, it gets taken off slowly. The damage now might be more from the second and third order effect, which is your investors, especially, we don't have that much left in the year, and we've got these other broader events, broader risks, the Middle East, US presidential elections. So how much money are people going to be willing to put into play, either for shorts or for longs? So those value at risk measures have blown out. So in Japan and elsewhere, people are going to be much more cautious about going in to major positions. That makes for, David Solomon was talking about plenty of volatility. Yeah, maybe going long volatility is your best play here, because that looks like sticking around. Some strong moves to the upside look doubtful. Probably still, when it comes to riskier assets, the skew is more towards the downside. Because when you look at the bond market is still pricing for moves not just in the US, but in Australia, for example, that could only come with a major economic collapse, or maybe not a collapse, but a severe economic downturn for the US and elsewhere. So even if you don't think the bond market is totally accurate in what it's pricing, it is pricing perhaps still a much greater risk of a major downturn than equities are at their current levels.
We're really seeing some of those assumptions that we've had over the years of the rally that, the U.S. economy was unstoppable, sort of being shaken now to the core. What about the earnings season? How's that shaping up? We also have SoftBank reporting today, but we know that the U.S. is almost done as well. Yeah,
well, you could argue the US earnings season hasn't really happened because NVIDIA is yet to report. A lot of people will be looking forward to that, wondering what that will reveal. one of those assumptions underpinning the idea that the US economy was just going to keep going up was that AI was unstoppable and was going to transform the economy or certain parts of it. So that's still a question that's hanging at least until NVIDIA reports. Any earnings season or any earnings releases going forward from here are going to be looked at very carefully for signs of whether economies, whether revenues, whether profitability is rolling over in a similar way to, I think, ultimately what we've seen out of the US, where it wasn't a bad earnings season. As ever, the guidance game meant that a lot of companies beat expectations, but the very clear message out of the US earnings season was that the Magnificent Seven were no longer so magnificent. That narrow foundation for the US and other equity rallies has crumbled. So the question then is, do we have some broader signs that the wider world, the wider corporate world, can make progress from here without that narrow tech base driving everything?
Garfield Reynolds from our Markets Live team with his views on the markets right now. As we were discussing earnings, investors will be watching SoftBank's results due later today. Analysts expect the company to report a small profit, even as billionaire founder Masayoshi Son prepares his next big AI bet. Our tech reporter Min-Jung Lee joins us now for more on this. And Min-Jung, what can we expect in today's results at a time when there's really more sort of skepticism when it comes to the AI rally and just tech names in general?
Right. Hi, Shery. So like you said, the group is estimated to report just a little bit of profit. This is thanks in part to the sale of extra T-Mobile shares. But then, like you mentioned, given the market, rocky market moves, the valuation losses, there's going to be some valuation losses for assets that are held under the Vision Fund. And this is going to have weighed on the earnings, therefore making the profit very thin. And now this is quite a bit of improvement from a year ago, but still, this speaks to how SoftBank overall may not be quite out of the woods yet, and market volatility definitely does not bode well for the company going forward.
No, neither for financing or his personal wealth, right? And it's so much focus in particular as he kind of gears up for the next big bet or multiple bets on AI.
Right. So this huge market volatility surely makes it really challenging for SoftBank to orchestrate its huge investment plans. And there has been growing anticipation that Masayoshi Son will step up investments both for his AI aspirations, for so-called super artificial intelligence. But with tech stocks still subject to heavy selling from time to time, his decisions will definitely come under a lot of scrutiny and will face a lot of questions on whether he's making the right decisions.
Our technology reporter Min-Jung Lee there. More ahead on the Asia trade. This is Bloomberg.
The Adani Group says it's planning a 150% increase in its output of solar panels by 2026 to bolster India's carbon net zero target and reduce dependence on Chinese firms. Today, in our exclusive look inside the Adani Group, we meet the man overseeing their energy business. Sagar Adani is a nephew of billionaire company founder Gautam Adani and one of 4 descendants handpicked as the next generation of leaders. We asked him about the green ambitions of a company better known for its coal business.
These workers are braving summer temperatures of over 40 degrees Celsius in western India, putting up rows of solar panels and giant wind turbines. This dusty and once barren salt desert is set to become one of the world's largest renewable energy parks, 5 times the size of Paris. This is being developed by India's biggest coal importer, the Adani Group, as it tries to align itself with the Indian government's climate goals. Tasked with meeting this challenge is Sagar Adani, nephew of Indian billionaire Gautam Adani. Though still in his early 30s, he's already spent nearly a decade at the Adani Group. As part of a succession plan envisaged by his uncle, Sagar is now in charge of the group's lucrative but contentious energy business. He also oversees finance for the whole group, which means he's well placed to answer the many questions investors still have about allegations made against the group last year by short seller Hindenburg Research, which the Adanis have denied. Bloomberg's Anto Anthony put those questions to Sagar in this exclusive interview.
When the Hindenburg report happened, a $150 billion wipeout happened in the group's wealth or the family's wealth because the institutional shareholdings in these companies were very low, I am assuming. Is there any other reason which you can think of?
So that is a perception that is very different from reality. So of course at that point in time, I would say that this report came as a shock to many people who were not expecting anything of this sort. From our viewpoint, purely this report was nothing but accumulation of everything that was written and alleged over the last 10 years before that, but also very beautifully gift wrapped and presented in a way that was, explosive and shocking, so to speak. So at the end of the day, if we are able to deliver our business in a consistent manner, after the Hindenburg report, right, we delivered the best results that the group had ever delivered in the history of the group.
Are there any specific plans to phase out the coal business in line with the targets which government has set? Any specific plans or any specific timeline?
So we will of course follow the government's guideline in terms of what the country needs. So in sync with that, whatever we need to do, we will do. But of course, our predominant focus is on renewables, is on sustainable energy. And with a significant push towards that, whatever we do with other sources will be a very, very small proportion of the larger context of how we invest.
So in line with the government's current projections and roadmap, what is the timeline within which you are looking at phasing out the coal?
So the government's looking at a gradual ramp down until 2060. So we have a lot of assets where we have PPAs. And we have obligations in which we have to supply to various state government discoms, central utilities, and to many discoms and to the end consumers ultimately. So those obligations, contractual obligations, of course, have to be met. Our thermal platform is completely ring-fenced. It's completely independent. So with the cash flow that that company generates, that company takes its independent call with regards to how it wants to invest its own cash flow. Some of it they'll use for growth, some of it they'll use to distribute. But again, all of those plans are going to be dependent on the demand profile of the country. So ultimately, if there is a significant demand further, if the country requires it, if the people require it, and if the government requires it, that company will make its own call. But from a family perspective, when we look at a larger investment portfolio, whatever the thermal and the fossil fuel business does is going to be a small proportion of our investments in the entire sustainable value chain.
That was our exclusive with Adani Green Energy's Executive Director, Sagar Adani. Let's get more insight now into India's energy sector. Joining us now is Tim Buckley, who's the founder and director of Climate Energy Finance. Tim, always great to chat with you. Let me just start off by getting your views on whether you see these renewables ambitions, as we just heard about, for both India and Adani as being feasible, and what are perhaps some of the risks?
Adani's renewable energy aspirations are entirely feasible. It is certainly working in lockstep with the Indian government. The Indian government offers 25-year power purchase agreements. Adani has been a major beneficiary of the government de-risking it. And then the government has also put 40% solar module import duties on Chinese product. And therefore, when Adani builds a very, very large solar module manufacturing facility in Gujarat, it's protected from Chinese competition by import barriers. But it is all part of India building out energy security and driving the decarbonisation agenda. What we need to see is India doing it about 5 times faster. In other words, India delivering on Prime Minister Modi's aspirations rather than running at maybe a third or a fifth of Prime Minister Modi's targets.
There's also record high coal capacity being added at the same time. And as you say, Adani may have these renewable ambitions, but they're walking both sides of that street.
Absolutely. And so when Sagar says that the coal division is ring-fenced, it's not. That's a legal construct that has no real legal credibility when you think about the economic substance of the Adani conglomerate. It is a family-controlled conglomerate. It's got about 8 listed subsidiaries or 9 listed subsidiaries, and each of those subsidiaries support each other. So on one side, Adani is the largest builder of renewables in India. On the other side, they're also the world's largest private developer of new coal mines. So they are absolutely, as you said, walking both sides of the street. They produced about 68 million tonnes of coal in the last 12 months, and they're looking to double that.
Tell us a little bit about the Indian market in terms of renewable manufacturers being able to access this growing economy, because we have seen Chinese manufacturers really targeting some of these renewable energy projects. But also, as we were talking about Adani, they're planning to boost their solar panel output by the next couple of years by 150% or so.
Yes, and I totally applaud that goal. It is excellent to see Adani targeting 10 gigawatts per annum of solar module manufacturing capacity. But it's worth bearing in mind, China, in the last 12 months in the 2023 calendar year, installed an absolutely staggering, world-leading 293 gigawatts of wind and solar across the whole of China in just 12 months. They're adding 22 gigawatts a month of new wind and solar. India has struggled to do anywhere near that even in a particular year. So India last year installed a record high 18.5 gigawatts of wind and solar. China does that in about 3 weeks. So it would be unbelievable for Prime Minister Modi to deliver on his 50 gigawatts per year target. But for the last 6 years in a row, we've seen them fall well short of that target. Even though renewable energy in India is by far the lowest cost source of energy, it's zero emissions, it's domestic, it diversifies the grid, it replaces imported coal and oil and gas, and it would also feed the development of the Indian economy and make it more sustainable. So India, like China, has a coal problem, but China is moving at unbelievable speed to actually solve this. And it's really a major opportunity for India to replicate the phenomenal drive to decarbonise progressively the Chinese economy. That same aspiration needs to be seen in India, and we need to see delivery rather than running at a third of aspiration. Like China, India needs to actually over-deliver on its aspirations. So they have all the potential. Adani is happy to work with the government and deliver whatever the government says they want. It would be great if Adani stopped expanding its coal plants at enormous speed and put all of that energy into solving the climate crisis at the same time as they solved India's energy needs.
Who are Adani's biggest competitors at this point in this industry? I mean, we talked a little bit about those Chinese manufacturers, but are there any other names that they should really think about?
At the end of the day, there are competitors like Tata Power and Renew Power, two very strong Indian leaders in the renewable energy space. But at the end of the day, there is so much capacity that needs to be invested. Like when we talk about China investing $2/3 of $1 trillion just last year in the clean tech space, it's really a race against Coal India and NTPC rather than Adani versus Tata versus Renew Power. There is more than enough there. If the government provides a contract for 25 years, it's really de-risking the sector. And so the opportunity is enormous, and we need Tata, Renew and Adani to all crowd in and deploy capital there. It's really a race to supply the booming strength of the Indian economy and provide the energy it needs from domestic zero emission sources rather than coal or imported fossil fuels.
Tim Buckley, good to have you with us, founder and director of Climate Energy Finance, talking us through, of course, the green energy transition in India. Our special coverage of the Adani Group continues all week. Tomorrow we hear from Jeet Adani, Gautam Adani's youngest son, who's overseeing India's biggest network of privately operated airports. Our coverage culminates with a special report on Friday at 11:30 a.m. Hong Kong time with an encore presentation at 7 p.m. That's 4:30 in Mumbai. We have more ahead on the Asia trade. This is Bloomberg.
And of course, as we continue to watch kind of the fragility when it comes to this market reaction, clearly we're setting up for not much of a positive start when it comes to trading here in Asia, and certainly US futures are trending in the opposite direction as well. Take a look at what we're seeing when it comes to the ways in which investors are sort of hedging these risks, right? We're seeing China, of course, considered quite counter-cyclical whenever we have a more global sense of a sell-off. That's coming to play there as well. Some of these defensive sectors have won favour as well in this rebound. We had that Asia gauge for the MSCI looking like the best day since November 2022, but still it is those defensives that are getting a better look, right? Emerging themes also include when it comes to that rotation to Chinese equities, and also a close look at just how vulnerable some of those AI shares as well, right? So you see this kind of buying of the dip, but it's certainly not across the board, Shery.
Yeah, and the vulnerability when it comes to financial shares here in Japan as well, with the BOJ rate hike and that exuberance that we saw earlier last week. But then this huge drop in banking shares amidst that rout that we saw on Monday as well. The first 3 days of August seeing the TOPIX Banks Index losing more than 26%. The Japan, Korean, Australia Open are next. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens after we saw that rebound in the U.S. session. Haidi, U.S. stocks really coming back from the brink of correction territory, but we might see a little bit of downside in the Asian session today.
Yeah, and certainly some of that risk of further sort of fragility being seen across Japanese equity markets in particular, right? There's still these ongoing concerns lingering that there's still some way to go, more pain ahead when it comes to the residual unwinding of the carry trade. And it is still down to central banks. We have had some pretty strong numbers out of New Zealand today, which again casts a question as to whether New Zealand, Australia are anywhere close to really the true start of an easing cycle.
Yeah, when it comes to that yen carry trade, JP Morgan saying that we're about halfway done when it comes to that unwinding. Nomura's Chris Willcox just told us that it may be a little bit more than that, but take a look at the Japanese yen because it's now continuing its downward trend, down 0.3% against the US dollar. And after the best day for Japanese equity since October, we're seeing a little bit more downside pressure in today's session. The Nikkei and the TOPIX both losing more than 1%. Of course, we continue to watch those yields. Right now sitting at that 87 basis point level. Of course, it's really about where the BOJ goes from here. Of course, we have seen that really optimism about the Japanese equity markets and whether or not that will be dampened by the economic outlook. We have seen that defense from the finance ministry when it comes to supporting the yen. We've now heard that about 3.9 trillion yen was spent in the beginning of May as currency interventions were still in place. Of course, we have seen that incredible rally since then. But take a look at how the Kospi is coming online because we had a little bit of a rebound after the worst day since 2008. We will continue to watch those big tech stocks, a little bit of downside in today's session, but a little bit of more strength when it comes to the Korean won. Of course, it's all about those tech exports. It's all about trade numbers as well, Haidi.
Yeah, and of course, so much for investors to kind of still be on edge about, given the events of the past few sessions. But take a look at how we're setting up for the Open when it comes to Australia. This is a staggered Open, of course, but we are already seeing a little bit of weakness there. Pretty flat start to the first few minutes of trade here on the ASX. Of course, we had the RBA, as expected, really holding, but still maintaining some of that sort of hawkish caution, right, when it comes to the fight against inflation. So not a lot of sort of hope, I guess, for investors that might be looking for a sooner than expected start to the easing cycle here. There's criticism, of course, from Bloomberg Intelligence, certainly, that the foundations of that may not necessarily be very strong, and certainly some of that mixed data would support that as well. The Aussie dollar, though, looking a little bit on the back foot there. 65.14 is where we're trading. And take a look at the Kiwi dollar as well. We saw that rise when it comes to the unemployment numbers coming through, and that really kind of gave a bit of food for thought when it comes to what we could expect from the RBNZ as well. That was surprisingly a beat on expectations. Treasuries there at the moment looking a little bit more stable. The sort of haven bid had started to wane at a point in the overnight session, but that 3-year auction did draw some decent demand. Let's bring in now Fan Cheuk, who's the Asia CIO at HSBC Global Private Banking and Wealth Fund. Always great to have you with us, and particularly interesting on a week like this. Do you think the volatility is over? And I guess what's your sort of thesis on the sell-off that we've had and the sort of selective rebound, if you will?
Yeah, we see the recent market volatility as a short-term tactical correction. We don't see a major reversal in the underlying fundamentals. So the recession fears look really overdone. And we don't think a single month of U.S. job data would be sufficient evidence to show imminent recession. So we think the soft landing scenario remains our base case. So we stick with our mildly risk-on investment strategy. But in the near term, we do expect market volatility may persist, especially with the significant investor repositioning for a more Fed rate cut. Currently, we expect 25 bp Fed rate cut before the end of the year. So we anticipate the September rate cut will materialize, and then we expect 2 more rate cut in November and December. But we don't expect the aggressive rate cut currently priced in the bond market. If we look at the Fed funds future market, the market is still pricing in around 125 bp rate cut before the end of the year that we think are exaggerated. So we recently moved our overweight position in U.S. Treasury back to neutral, given the significant movement in the bond market. But we think the equity market actually provides buy on dip opportunities, especially for quality stocks. So we think the market will see more recovery scope in the coming months after we weather the near-term volatility and uncertainty.
And selection is perhaps more important than ever. Not that it's never not important, but Fan, I do wanted to get your thoughts on our MLive blog question of the day, which is asking which major stock market will be the best performer after this sort of washout, right, and the sell-off. We've seen China or the CSI 300 being the only market posting gains in dollar terms over the past 5 days. Where do you see the opportunities now that this has happened?
Yeah, I think for the next 6 months, we still believe corporate earnings would be the most important driver for the equity market. So we currently stick with our overweight allocation to global equities, and we have overweight positions in the US, UK, India, Japan, and South Korea. The Japan equity market will likely see further volatility in the short term, mainly because of the ongoing unwinding of the yen carry trade. But according to our analysis, the unwinding of the speculative short position on yen have largely completed by 60%. So we have seen 60% reduction of the short yen position by the end of July. So there could be some more unwinding of the yen carry trade in the coming week. So this will add to volatility of the Japanese equity market. But if we look at the fundamental, the reflation trend in Japan has become more sustainable. That is the key reason why the BOJ raised policy rate, and with more positive growth outlook, and we also expect the consumer spending sentiments to improve further in Japan. So we think after the unwinding yen carry trade settle down, then the market will refocus on the underlying fundamental.
And will that include a boost towards those tech giants that are really trading around the AI narrative? Because we have seen that incredible correlation when it comes to the Japanese yen with the Philadelphia Semiconductor Index, for example, even a higher correlation than that with Japan's own topic. So if we continue to see this yen unwind slowing down, does that mean a little bit more upside for some of those tech stocks where we've seen a little bit more concerns around their valuations and how stretched they are?
Yeah, I think the pullback in big tech stocks is not totally surprising because of very concentrated investor positioning in the Magnificent Seven, and the big tech stock have rallied that to hit a really high valuation level. But we also focus on the long-term structural growth opportunities coming from those quality AI-driven tech leaders. So after the latest round of pullback, we actually see attractive re-entry opportunities emerging. But in the near term, as the volatility will stay elevated, there could be even a more attractive re-entry opportunity. So I think the over-concentrated position in mega tech will continue to adjust as investors are now repositioning and rotate into the less expensive sector, which also benefit from the U.S. soft landing scenario. So our advice to investors is to broaden the equity exposure across geographies and sector, because the equity bull run will likely continue after the short-term tactical pullback, and this will benefit a broader range of sector.
So we have seen really investors trying to position themselves for the U.S. presidential election, whether it's the Trump trade or the unwinding of the Trump trade. We're hearing more sources telling us that we might see more limitations when it comes to the Biden administration restricting U.S. sales of Chinese vehicle software, for example. Are there some of the sectors that we should be watching out for going into November?
Yeah, I think going into November, we should embrace market volatility, because historically, the equity market would see heightened volatility 2 months ahead of the U.S. presidential election. But we think the sector impact from the outcome of the U.S. election would also hinge on the outcome of the Congress election, because it's not just the election of the new president that will have impact on the market. Whether we will see a split Congress, or would there be a swift victory of any party, would have more meaningful implication on the sector outlook. Because after all, following the presidential election, the dynamics in the U.S. Congress would have impact on the legislative process, especially for those more controversial policy change. So I think it would look premature to build positions purely based on the outcome of the presidential election. And the latest national polls also shows that this upcoming November election will likely be the most unpredictable and tightly competed race. So we think it's more advisable to position the portfolio based on the rates and corporate earnings outlook.
Cheuk, Asia CIO at HSBC Global Private Banking and Wealth. Good to have you with us. Take a look at some of the early movers in the Asian session. Of course, we're following Samsung and some of those chip makers. We have earnings season underway, but also a report now saying that a version of Samsung Electronics' fifth generation HBM3E chips have passed NVIDIA's tests. Of course, this was very much awaited to see if Samsung could get NVIDIA's business and how that could potentially help it catch up with its rival SK Hynix when it comes to these very advanced chips. We are also watching SoftBank at the moment, given that we do have earnings results coming out very soon. The expectation right now is for a small profit. This is Bloomberg.
We need to move to the general election and win that. And to all the friends, listen, we also need to level set. We are the underdogs in this race. But we have the momentum, and I know exactly what we are up against.
U.S. Vice President Kamala Harris after announcing Minnesota Governor Tim Walz as her running mate on the Democratic ticket. For more, let's bring in national politics reporter Hadriana Lowenkron. Hadriana, so this seems to be a typical case of sort of ticket balancing, complementing Kamala Harris, right? But why did she choose Walz instead of the Pennsylvania governor, for example?
There were a lot of things that she was looking at. One of the things that Walz really brings to the table is his Midwestern appeal, by which I mean, obviously Minnesota has been reliably blue, but there are still rural and working class white voters in areas that are really important for Harris to take. For example, we call it the blue wall, Pennsylvania, Wisconsin, and Michigan, and he just has a way with his words, even calling the Trump campaign, the vice presidential nominee Vance and the Republican Party weird, has managed to become the new Democratic messaging strategy because it seems to work. And so that is really the appeal that he brings to the ticket.
Does this change kind of the state of the race? I know a lot of people are looking forward to a potential vice presidential debate now between Walz and J.D. Vance. What are the polls showing us? Because it continues to look very, very close.
It definitely is close. No one has it in the bag. This is something that candidates on both sides have said they will not take anywhere for granted. Yes, we are expecting to see some type of VP debate. I think both candidates today, Vance ahead of a rally, they were actually both in Philadelphia, and both have indicated that they were looking forward to a debate of some sort. Whether we get a debate between Trump and Harris is a completely separate story. There's a back and forth, whether at Fox, ABC, maybe they'll just do two separate town halls, one-on-one, which would be definitely different, but we're in an unprecedented time. But in terms of the state of the election, we are seeing a couple of things on the polling front. Harris is rising. We are just seeing a recent poll out of, I think it was the New York Times, that shows that she is now above Trump. Bloomberg has our own poll looking at swing states, showing her erasing a lot of Trump gains. And on the money front, we're really seeing enthusiasm translating into fundraising dollars on the Democratic side.
What comes next when it comes to this campaign? They've launched in Philadelphia, the biggest city in the most populous swing state. So, what are the biggest challenges and what will they be focusing on in the weeks to come?
So on both sides, actually, but, focusing on Harris and Walz, Philadelphia was just the start of really a multi-swing state swing, as it were, taking, the duo will be going to Wisconsin, Michigan, Arizona, Nevada. And I think, these are the states that they need to focus on. These are the big states. They're going to be looking at cities specifically looking at Black voters, young voters, voters of color. These are places where we saw under Biden a little bit of people, turning away. And we did see kind of those numbers drop. With Harris back at the top of the ticket, we're seeing enthusiasm there. And then, of course, as I just mentioned, on the other side, looking at the rural voters, the white working class voters, that's when Walz, and that's where Walz comes in. And that's how they're able to really, see the difference in that polling. But obviously, there's a long way to go. This swing is just one of what will be many for sure.
A national politics reporter, Adriana Lowenkron, there with the latest. And Bloomberg's been told that the Biden administration officials plan to propose limits on U.S. sales of Chinese vehicle software as soon as this month. Our China correspondent Min Min Lo joins us now with the details out of Hong Kong. So, Min Min, what are we looking at in terms of these curbs?
Yeah, this is a follow-up to the investigation launched in March by the Biden administration looking into the cybersecurity threat posed by Chinese vehicle software. And the aim is to prevent these software from collecting data on U.S. drivers and then sending those data back to China. Because many smart cars and new cars these days have devices that connect them to the internet, which makes them a potential target for hackers. The new restrictions are expected to focus on Chinese software, potentially also the hardware embedded in them. And according to our sources, there may be a later round of restrictions targeted at hardware as well. Now, Beijing has, of course, denied any allegations that its technology is a national security threat to the U.S. Instead, it says the U.S. is unfairly trying to suppress Chinese companies. And this is, of course, after the U.S. had banned a key Chinese firm that makes those LiDAR technology, which is the laser tech that is used in autonomous vehicles to detect barriers and roadblocks, for instance. That came about after a U.S. firm making the same technology had pushed for it. Now, from what we understand, these new restrictions will likely involve a phase-in period for companies to look for alternative sources of supply from other U.S. trade partners. And that came about after groups like German automakers and the Korean government have been pushing the U.S. to limit the scope of these new restrictions and to give them more time to adjust their supply chain.
Min Min Lo, in the meantime, we are getting those trade numbers for July out of China today. What are we expecting?
Yeah, so remember we had that record high trade surplus of about $99 billion last month. This month, the trade surplus is expected to remain high at around $98 billion. Export expected to increase further to 9.5%, up from the previous month. Imports expected to grow as well to over 3%. So again, this underscores the idea that China is still relying very heavily on industrial production and exports to boost growth. And there are a lot of headwinds when it comes to that, because a potential Trump win could mean more tariffs on Chinese goods. A potential U.S. recession could mean less demand for Chinese goods. There's also the issue of China, for instance, their producers not actually making a lot of profits out of this because the price war at home has forced many companies to cut prices. And that's why the total value of goods exported had only crept up by 0.4%. You saw that screen just now. The inflation numbers also expected to remain soft later this week, and that has caused some economists to cut down their growth forecast to China. Citi, for example, adjusted down their growth forecast to just 4.8% this year.
Bloomberg's China correspondent Min Min Lo there with the details of what we're looking at. And take a look at China bonds, or bonds more generally. Of course, we've seen that sort of to and fro when it comes to treasuries after we did see really some of that sort of haven bid start to fade a little bit. We're seeing that direction, though, being rebuilt when it comes to both US treasuries and JGBs at the moment. When it comes to China bonds at the moment, we're watching sort of some of the vulnerabilities when it comes to local government debt still that $9 trillion market now back into focus there, and sort of a potential question over issuance as well. But we have seen when it comes to the equity side for China kind of playing against that counter-cyclical hedge against the recent market volatility. We've seen the CSI 300 being one of the only markets really, at least in dollar terms, to see a gain over the past 5 sessions on the back of this broader global sell-off. More ahead on the Asia trade. This is Bloomberg.
Take a look at how Japanese assets are trading at the moment. We're seeing downside pressure in equity markets. After the best day since October, we had that jump of Japanese stocks about 9% in the previous session. But on the topics, we're seeing consumer discretionary, energy and material stocks leading the declines, although banks are gaining a little bit of ground at the moment in today's session. The Japanese yen continues its downward trend at that 145 level against the U.S. dollar. We are waiting for earnings results as well from SoftBank later today. Now, Christopher Willcox, executive officer and head of wholesale at Nomura, says that the BOJ's rate hike last week was appropriate. Willcox spoke to us earlier about the central bank's rate path and what's next for the Japanese yen.
I think there was pressure on the BOJ caused by dollar yen. However, many people have questioned whether the rate rise from the BOJ was a mistake and whether that's led to some of this turmoil. I would say that the BOJ has been completely vindicated because, firstly, it's proven to us that unwinding a very easy policy over a long period of time is likely to be a bit bumpy. So we've had this extraordinarily easy policy to deal with the deflationary environment. It seems like the deflationary environment in Japan is being dealt with. But they always knew that this unwind was going to be very difficult. That's why they've been so slow and so cautious. And yes, that puts some pressure on the yen for a little while. But I think it's right. And think about the carry trade. The point of the carry trade is that if they didn't start to move, the carry trade would only have got bigger. And so the end disruption of the unwinding of the carry trade would have been even bigger. So I think the BOJ is playing it extremely smartly.
All right, that was Nomura's executive officer and head of wholesale, Christopher Willcox, really talking about, I guess, some of the blame that's being cast on the Bank of Japan at the moment when it comes to this elongated sell-off. Take a look at how futures in Europe are opening up at the moment, looking pretty mixed at this point, at least a little bit of upside there when it comes to equity futures. This is Bloomberg.
I think we're going to see more volatility in the short term here. This was a pretty big, pretty meaningful correction and a big unwind of leverage, as we have discussed, in certain parts of the system. My guess is we'll see a little bit more rebalancing. But my base case is still that there's a good chance the economy is still in reasonable shape. As we said a few moments ago, the jobs report, while it was disappointing, wasn't a bad jobs report. The unemployment levels are not bad unemployment levels. And so my base case is we're still set up, to kind of muddle through. But I do think in the short term here, the next couple of weeks, we might see a little bit more market volatility as this all rebalances.
Goldman Sachs CEO David Solomon there speaking to Bloomberg about his outlook for the markets and volatility potentially ahead. He also told us that the Fed will probably avoid taking emergency measures and steps to lower borrowing costs. He sees the U.S. economy as skirting a recession despite last week's jobs data. Solomon says he does not expect the Fed to move before its next policy meeting in September. He's also predicting 1 or 2 cuts later this year.
I don't expect that you'll see anything before September. We do have a long period now. We've got 40 days until the next Fed meeting, which actually I think is a reasonable period of time for the market to digest more of the news. I'd say the market expectation is certainly for cuts in the fall. I've been more cautious around interest rate cuts all year. As you remember, the market expectation early in the year was for 6 or 7 cuts. Based on the economic data we're seeing now and the messaging from the Fed, I think it's likely that we'll see a cut or 2 in the fall. But I think you've still got to wait and see as things unfold. And, the economic trajectory over the next couple of months and additional economic data will certainly have an impact on that.
Take a look at how Asian markets are trading early in the session. A little bit of a mixed picture with the Kospi gaining 0.9% despite the fact that we're seeing a broader downtrend across Asia, perhaps being helped by Samsung Electronics, the biggest stock on the index. Of course, we are hearing reports that their 5th generation HBM3E chips have passed NVIDIA's tests. But take a look at the Nikkei, down 1.5%. Although one sector bucking the trend are banks. They are gaining ground after that 17% loss on Monday. We are expecting earnings results from SoftBank, as well as we keep an eye on the Japanese yen continuing its downtrend. But of course, the recent strength that we saw in the Japanese currency really leading to the unwinding of yen-funded carry trades triggered by last week's BOJ rate hike. That's been really fueling concerns over investors' frothy exposures to U.S. tech. Bloomberg opinion columnist Shuli has been looking closer at this. We've been talking about the carry trade for a while, and JP Morgan now saying that perhaps half of that unwinding is done. We heard from Nomura's Chris Willcox saying that perhaps more has been done. But what is the transmission mechanism here from the carry trade unwind to the global markets that's so concerning?
So, Shery, what's happening is that we all know that the yen carry trade has been very popular because a weaker yen and the zero interest rate yen has been a one-way bet for a lot of people on Wall Street as well as within Japan. What's happening possibly is that people were taking out a very cheap yen loan, exchange it into U.S. dollars, and use that money to buy into frothy assets like a U.S. big tech, the Magnificent Seven. And another thing is that earlier this week we have seen a lot of margin. Probably there were a lot of margin calls, right? And the investors, when they look at their portfolio, they will want to sell the most liquid asset, and the U.S. big tech is obviously a very good candidate.
It's interesting in your piece, arguably you could say that the BOJ itself has been engaged in a massive carry trade. So what happens now that it's, changed the playbook?
I think what's happening with the Japanese government is that the yen has been too much of a one-way bet. Everybody was shorting the yen. That's why the carry trade was becoming very popular, right? And what the Japanese government needs to do somehow is to make the yen into a two-way bet, just like what PBOC did with the Chinese yuan about 1 decade ago. And then that will gradually deflate the carry trade idea, and then we can go back to the normal steps.
What should we expect on money flows from Japanese investors themselves? Because with the rate hikes and perhaps markets, assets becoming more attractive here in Japan, there has been a lot of concern about what happens to the treasury space, what happens to all of these Japanese money perhaps flowing back to domestic assets.
Right. It's a very serious concern because Japanese overseas international net investment reached $3.4 trillion, about 15-16% rise from 3 years ago. And even the GPIF, Japan's biggest pension fund, they have $1.8 trillion asset under management, right? And half of that is overseas assets. So if the BOJ raises rates even further, I mean, it will be inevitable for them to bring some of that money home. And that perhaps gives some warning to the BOJ and saying, oh, you cannot raise rates all that fast.
Obviously, people that are looking for blame are looking at the Bank of Japan, that it wasn't, well communicated, that they did this too early and too suddenly. Do you think that's the case? And, if so or not, how does this, I guess, guide what they do next?
I think it's just a matter of time. I mean, it's pretty clear Japan is out of the deflationary period, and it's just a matter of time that the BOJ raises rates. And perhaps it is better now than never. I mean, the yen carry trade just has become so popular in the last 3 years, especially with the U.S. Raising rates, right? So they just have to do it. And I mean, Japan matters. It's a very important market. So there should be no surprise that we have this kind of havoc.
Bloomberg opinion columnist Shuli Ren there. We have more ahead on the Asia trade. This is Bloomberg.
The Adani Group says it's planning a 150% increase in its output of solar panels by 2026 to bolster India's carbon net zero target and reduce dependence on Chinese firms. Today, in our exclusive look inside the Adani Group, we meet the man overseeing their energy business. Sagar Adani is a nephew of billionaire company founder Gautam Adani and one of 4 descendants handpicked as the next generation of leaders. We asked him about the green ambitions of a company better known for its coal business.
These workers are braving summer temperatures of over 40 degrees Celsius in western India, putting up rows of solar panels and giant wind turbines. This dusty and once barren salt desert is set to become one of the world's largest renewable energy parks, 5 times the size of Paris. This is being developed by India's biggest coal importer, the Adani Group, as it tries to align itself with the Indian government's climate goals. Tasked with meeting this challenge is Sagar Adani, nephew of Indian billionaire Gautam Adani. Though still in his early 30s, he's already spent nearly a decade at the Adani Group. As part of a succession plan envisaged by his uncle, Sagar is now in charge of the group's lucrative but contentious energy business. He also oversees finance for the whole group, which means he's well placed to answer the many questions investors still have about allegations made against the group last year by short seller Hindenburg Research, which the Adanis have denied. Bloomberg's Anto Anthony put those questions to Sagar in this exclusive interview.
When the Hindenburg report happened, a $150 billion wipeout happened in the group's wealth or the family's wealth because the institutional shareholdings in these companies were very low, I am assuming. Is there any other reason which you can think of?
So that is a perception that is very different from reality. So of course at that point in time, I would say that this report came as a shock to many people who were not expecting anything of this sort. From our viewpoint, purely this report was nothing but accumulation of everything that was written and alleged over the last 10 years before that, but also very beautifully gift wrapped and presented in a way that was, explosive and shocking, so to speak. So at the end of the day, if we are able to deliver our business in a consistent manner, after the Hindenburg report, right, we delivered the best results that the group had ever delivered in the history of the group. As far as institutional shareholding goes, people don't understand this, but we probably have some of the most diverse institutional shareholding, long-term equity in our portfolio compared to any other global businesses, or certainly most of the businesses domestically. We have long-term players like QIA from Qatar, sovereign wealth. We have sovereign wealth funds that participate with us. We have strategic equity partners who participate with us, Total Energies of France. We have a lot of other smaller institutional participants in our ecosystem. We have corporates like IHC, which are some of the largest companies in the Middle East who participate together with us. We have participants in our portfolio and our platform across every single type of investor base that there exists in the world. So yes, there were concerns. We sat down with our partners, we explained to them in terms of what we actually do, what the real factual situation is. And once they understood, they were comfortable. And those same partners who there were allegations that they were worried they don't participate with us anymore, strategic long-term global equity partners, they've only doubled down since the Hindenburg report came.
If I'm looking over the last 5 to 6 years, we see a 20 or 30-fold surge in the group's market cap. What explains such a huge premium for infrastructure companies? What are you offering investors here?
So today, you look at it as a significant premium for an infrastructure company. We look at it from our perspective as these infrastructure platforms available for investors today at some of the lowest valuation multiples anywhere in the world. So us knowing the company's growth path, knowing what we're executing on already today with our known projects and our committed investments, over the next 3 to 5 years, the growth that every single one of these companies will have will means that investors participating in our listed companies today have access to this opportunity at some of the lowest growth adjusted multiples anywhere in the world. So we look at it the complete opposite way as what the perception of yours and market perception is. But overall, ultimately, what are we offering to the investors? We think that we have a once in a generation opportunity of investing significantly in the type of assets that have long-term 35-year, 40-year stability. The assets we invest in, ports, roads, airports, railways, renewable power, thermal power, transmission lines, distribution companies, data centers, all these assets are long-term assets.
Why are the analysts not able to understand your business models? For instance, if I'm looking at some of the Adani Group companies, there is absolutely no analyst coverage or just one or two analysts are tracking it. Where is that disconnect coming from?
So always, whenever you see analysts in the context of the country, they have never seen before a platform of infrastructure growing at the speed that we have been growing. There has always been a mindset of, analysts have many times covered various companies, right? Government companies, infrastructure. There's no other private large infrastructure platform in the country. So analysts have been looking at various other companies where there's a 10%, 20% year-on-year growth, quarter-on-quarter growth. Many times the investors that they cover are also investors who are quarter-on-quarter, 6-monthly, year-on-year investors. We don't offer anything to our investors on a quarter-to-quarter basis. Our assets are 30 years, 40 years, 45 years. So our target investors are not ones that look at quarter-on-quarter results and determine investment potential. Our target investors are ones that look at a 10-year horizon, 20-year horizon, 30-year horizon. And analysts in India have historically not covered that. When I say all this, we also recognize that it's our duty to make sure that we engage with the analyst community much deeper, much stronger. We're already doing that. So you will see that a lot of analyst reports have come out over the last year and a half, which were not there earlier. Global companies like Cantor Fitzgerald, some of the top investment banks in the US, Jefferies, many of the Indian analysts, Sunidhi, Ventura, they've all started to cover us, which they did not a year and a half ago.
There is a long-running allegation against the group that the family is holding much higher stake than it is disclosing through overseas entities, and the real public float of the company is lesser than what it claims to be. How do you address that concern?
See, such stupidity does not even deserve an answer, to be very honest with you. For us, we're working in a regulatory context of SEBI, in a market like India where everything is fully publicly disclosed. These allegations have been there over last many, many years, many, many months. Every single regulator of multiple jurisdictions has looked at everything multiple times and has found nothing.
And if I may ask, the US DOJ investigation, which has widened of late to figure out whether group-related entities or people have paid some bribes in India. This is the news that Bloomberg had reported. Now, this is a business which comes under your purview. Do you know anything about this?
So we as a company policy don't typically respond on legal or quasi-legal matters. We made a public statement about this overall anyways, that if there is even an entity that looks at it, it's in due course of their regular business and their regular interactions. So there's nothing specifically in particular that we have to disclose to the market that's separate or in addition from that.
There seems to be widely held perception that the group's fortunes are very closely tied to Prime Minister Narendra Modi's. How do you address this concern?
See, I think there is a very strong difference between perception and factual reality. People's perceptions beyond a point we can't do much about, but if you look at factual reality of what we've done across the group, right? Majority of our growth period as the Adani portfolio of companies and the Adani Group overall has come prior to the, if you look at pure, growth of businesses, growth of assets, growth of cash flow, a predominant foundation of that, majority of that has come prior to the time of Prime Minister Modi. Even today, when a certain party is in power, we work in 22 different states all across the country. Most of those states, many of those states are non-BJP states, right? Ultimately, what people don't realize outside is that from a business perspective, most of the businesses is done in the states, not in the center. Most of the action, most of the growth, most of the assets, most of the concessions happens at a state level, where there is regional parties, where there's opposition parties, where there's the same party as the ruling party in the center, and we work across all different political parties, because the thing that we fundamentally do is infrastructure. And for that, an alignment with the objectives of the government is very, very important. And that's the fundamental success story that we've had over the last 30 years, not the last 10 years that Prime Minister Modi has been in power. It's fiction or a fairy tale that a company can grow so big in 5 years or 10 years. Nothing like that exists anywhere in the world.
Are there any specific plans to phase out the coal business in line with the targets which government has set? Any specific plans or any specific timeline?
So we will, of course, follow the government's guideline in terms of what the country needs. So in sync with that, whatever we need to do, we will do. But of course, our predominant focus is on renewables, is on sustainable energy. And with a significant push towards that, whatever we do with other sources will be a very, very small proportion of the larger context of how we invest.
So in line with the government's current projections and roadmap, what is the timeline within which you are looking at phasing out the coal?
So government's looking at a gradual ramp down until 2060. So we have a lot of assets where we have PPAs. And we have obligations in which we have to supply to various state government discoms, central utilities, and to many discoms and to the end consumers ultimately. So those obligations, contractual obligations, of course, have to be met. Our thermal platform is completely ring-fenced. It's completely independent. So with the cash flow that that company generates, that company takes its independent call with regards to how it wants to invest its own cash flow. Some of it they'll use for growth, some of it they'll use to distribute. But again, all of those plans are going to be dependent on the demand profile of the country. So ultimately, if there is a significant demand further, if the country requires it, if the people require it, and if the government requires it, that company will make its own call. But from a family perspective, when we look at a larger investment portfolio, whatever the thermal and the fossil fuel business does is going to be a small proportion of our investments in the entire sustainable value chain.
Once Mr. Gautam Adani steps away, we wouldn't have anybody who can take a final call on things. It's a joint decision making from what I understand. How will that work out?
So already there is a very, very close interaction between all the, so to speak, G2 members. We have our regular meeting cadences. We meet in a very structured manner once every week. We make sure that all important decisions are all socialized, are all discussed jointly, and there is, in different aspects, different people take leads, but everyone's views are always incorporated in however we do everything. So that's something that we have already been practicing over the last about year and a half, and that's something that's becoming deeper and deeper and deeper as we move forward.
That was our exclusive with Adani Green Energy's Executive Director, Sagar Adani. Our special coverage of the Adani Group continues all week. Tomorrow we'll be hearing from Jeet Adani, who's Gautam Adani's younger son, who's overseeing India's biggest network of privately operated airports. Our coverage culminates with a special report on Friday at 11:30 a.m. Hong Kong time, an encore presentation at 7 p.m. That's 4:30 in Mumbai. Shery.
Haidi, take a look at some of the latest from the corporate front as well. Disney shares closed higher in New York after the entertainment giant announced it's raising the prices of its streaming services. The price for its cheapest offering, Disney Plus, with advertising will climb 25% to almost $10 a month. Disney Plus without ads will cost nearly $16 a month, marking a 14% increase. The changes take effect on October 17th. Shares of Airbnb fell sharply in extended trading. That's after a disappointing outlook for a third consecutive quarter and a warning of slowing demand from U.S. travelers. Airbnb says it expects sequential moderation of growth on the key metric of nights and experiences booked in the current period. We have more ahead on the Asia Trade. This is Bloomberg.
Take a look at broader commodities, and we are seeing really that retreat across the board as some of the volatility continues to remain in these global markets when it comes to risk appetite. Take a look at oil at the moment. We're seeing Brent crude off by about 0.3%. Still pretty steady, though, given that we did see kind of a short-lived risk-on gain. The market is still watching the potential of that retaliatory strike from Iran on Israel, but perhaps more focusing for now the industry reporting with data pointing to the expansion of U.S. crude as well well as fuel stocks as well. So still a lot of headwinds there from faltering demand out of the major market in China and the US, and that addition of supply starting from next quarter from OPEC Plus as well. Watching copper, I should say, not much of that rebound, and we're still looking at about that 4-month low there as we continue to see the downside pressure on base metals.
A little bit of a rebound when it comes to Japanese equity markets. We're seeing the broader, more diversified topics now gaining almost 1%. Of course, this is a market cap weighted index. And we're seeing the Nikkei, though, down 0.5%. Perhaps one sector that's really powering the topics at the moment, those financials, with the Topics Bank Index now rallying more than 6%. Of course, remember that 17% plunge in the Monday session. But today we have the likes of Mitsubishi UFJ, Sumitomo Mitsui leading the gains with advances of more than 5%. But the Japanese yen holding steady at that 144 level with a little bit more downtrend at the moment.
Yeah, speaking of that downtrend, take a look at US futures and really kind of dropping in concert with some of the weakness that we're seeing across patches of the market there as well. S&P futures looking pretty flat at the moment. TAIEX futures looking like we could see a little bit more of that rebound story, as well as A50 China futures about 0.25% higher. We have seen some select Chinese equities as kind of being the beneficiaries of the broader global sell-off. That is it for the Asia trade. This is Bloomberg.